when I taught imbalances and efficiencies in price, I told you to look at first the wicks. Then we graduated to then looking for when there's a volume imbalance. A volume imbalance is something like this right here. If you look at the close on that candlestick, you see that? It's 100.997. So the open of the next candle needs to be higher than that to be a volume imbalance. So anything above 997, well, look at that. It's over it at 101.005. That's certainly higher than 100, right? So there's a volume imbalance there. So in classic terms, when I first introduced fair value gaps, this is what we were seeing. Okay, you see that? And then eventually, when I felt it was merited, I gave you all a deeper perspective in price action where we include the volume imbalance, where we would discount this short term wick high and go right down to the candlestick's close. See that? And that became the fair value gap. Now, that's two measurements to get a inefficiency defined. But now when we're going to use these inefficiencies, we can now project them into the future and determine very specific price points in an unrealized dealing range. What was that? That's a lot of word salad there, isn't it? So if we are bullish, okay, and I'm going to make the case, and it's going to be a stretch for some of you to believe it, but on the 7th of June, I told you that I felt that we were going to try to gravitate towards this level on the dollar index. Therefore, putting downside momentum in play for euro dollar and pound dollar. So if dollar's going to go up, that teeter totter effect, if this is going up, it's going to allow euro dollar and pound dollar to go lower in concert with the appreciation higher in dollar index. So I'm looking at the time and I'm already getting too long winded. So I got 15 minutes to wrap this bit up and go into the review. I know some of you like, just keep going. We like the long ones. I don't want to make this one a long one. So I'm being very conscious of it. But this day here, while we were right up here, I said that it's good for you to take your profits. Now I know some of you are short on euro dollar. I know some of you were short on pound dollar. And I know some of you made lots of money doing that. I don't want to see it, so stop sending it to me. Okay? That's your business, it's not my business. But I'm also not trying to be the oracle. So don't use me as the timing element for you to get in or get out of your trade, okay? Because then I'm managing your trade for you and you're not getting experience by that. The only thing you're doing is tethering yourself to my opinion. So just like we have two ways of measuring and defining the imbalance, when we do measurements for targeting, there's a low hanging fruit objective, and then there is the extreme. Okay. So I'm going to teach you something in regards to fair value gaps that Chris Laurie never heard about. The guy he learned from never learned about. Everybody out there that does everything else in price action. Okay. Mr. Al Brooks. Okay. You're not going to see him teaching this stuff. Okay. It ain't there. Okay. And I want you to really pay attention to this because this is why my executions are laser precision. This is the reason why these types of things, this isn't all there is. And you don't need this to make money using my concepts. But I'm just doing this to kind of like stimulate your thought process about what it is you're learning here and why you should not fear these markets because they're absolutely rigged. They're 100% rigged. And if there was no evidence to that, what I'm showing you week after week, month after month, year after year, it wouldn't hold up. But yet it does. We're going to make this a little bit bigger. She never said that. So the open of this candlestick starts this price run here. Okay, so it's candlestick number 2 in the fair value gap. So we're seeing the protraction higher, this displacement above these highs here, this run. Resist the temptation to call that an engulfing candle, okay? Because engulfing it doesn't really adequately describe what's going on. It's displacing. It's leaving an area where this candlestick closed. We opened higher. So what did it create? A gap, opening range gap, trades lower, and it rallies up because it's drawing towards this level up here. This is the draw. This is the big magnet in price action. If I'm going to measure the the influence for the unrealized dealing range, and what is that? The unrealized dealing range is when this candlestick starts and opens higher than this one, it trades down and starts to rally up. Sometime during this day, price was sitting around here. Okay. I'm trying to paint this for you. When price was sitting right here, and we'll say it like this, price was essentially around there. Okay. And this is where on the 7th and before that, earlier in the year, I told you we were going to go towards this level in dollar index. Between this price point or any time during that day, whenever you were looking at it, between that price point and say that was the highest high it had formed for that day so far. So in other words, anything above this line hadn't yet formed. From this point here up to that level, this is what I call an implied dealing range. It's an unrealized dealing range. It means it has not traded there yet. We have an opinion that's going to take us up here, but we have to wait and submit to time. So from here to here, we can start getting an idea where price may reach for. Okay. So this has taken out the previous day's high. So it's an almost guarantee that this is going to be the next run higher. So start where that candlestick opened for the day, right there. Okay. So now from this candlestick's open all the way up to this high, that's an unrealized dealing range. We suspect that price will go there. See, your volume imbalance gives you clues on how to measure certain things. Order flow doesn't determine these types of things. Elliott Wave isn't doing those things. Supply and demand isn't doing that. Okay. Larry Williams isn't doing that. Okay. No disrespect, Mr. Williams. But the point is, this day was Wednesday. It was literally, it was literally part of a sustained price run that got close to our target, but we're on hump day, Wednesday. And we could see a midweek retracement or reversal. And because we hit targets on euro dollar and pound dollar at the same time this was occurring, hello, what up here at this price is significant? Well, let's take a look at the Fibonacci now. This is simply just math, folks. Okay. Math applied to algorithmic principles. If there is an algorithm, and I know we're all supposed to be believing that there isn't one right now, just for the sake of the discussion in the lecture. If I plot that fib from the low of this candlestick body, which is the opening, and drag it on up to the low of this candlestick right there. See what I'm doing? I'm measuring the point at which this displacement begins. It's part of the power three of that day, carried over to the very next day. This candlestick opened here, dropped down a little bit, and then from there, it showed its willingness to want to go higher. So there's discount sensitivity on that low. We started on the power three element here, and I already know some of you you're already churning the channel. You're already saying this is too much, and that's okay. But I promise you, there's charter students right now that are drooling, and trust me, I'm going somewhere. This low from that candlestick's opening price, that right there is consequent encouragement. That's not concerning. That's not the focus. But what we want to do now is add a level right there. What is that? Negative 1.25. What's the 25? We're assuming that this run here at that open to that low, that range projected in the future, 1.25, that takes us right about there. So here we have 101.795 right there. And then that's the low hanging fruit objective on this measurement. Okay. We have to now get the extreme. What is that going to be? Well, we have a volume imbalance. It's lower than there. Okay. So we have to use the point at which the day closed. So the body tells you the story, the wicks do the damage, right? So we're going to go over to that opening price, I'm sorry, closing price to open up that fib a little bit further up. And there you go. So now we have 101.805. Okay, you see that? Now, watch, folks. In the recording I was showing you last time, while Price was moving around, meandering, and Caleb sitting right next to me, I was explaining to him that this is going to show a strong likelihood of retracing right from this price level. Now, okay. So now if we have a fib anchored to this 80 and a half down to 79 and a half, make sure it's showing on the numbers. Okay. That off. And this right here, we're going to put it as a blue line. Actually, make it a little bit darker like that. I'll extend it out a little bit. It's not too many. All right. So you have a projected portion of price action using my fair value gap, using power three, using the bodies and the wicks to determine a low hanging fruit objective and an extreme projection as well. And between the two, we can measure that out. Now, trust me, I already know what some of you are thinking. How did he figure this out? Right, because if it wasn't him tapping me on the shoulder, say, "Look here," it wouldn't have happened. So all the glory goes to him. So don't call me a genius because it's all coming directly from him. Nobody else out there is teaching this, folks. Because believe me, if they were, I'd be pointing to them saying, "Hey, check this guy out." Okay, but apparently I'm the guy. So here's consequent encroachment of those two levels. Look at the high of that candlestick. As I was telling you in the recording while the analysis was being talked over live, price action, not market replay, not form fitted, not cherry picked. Okay. Right up in here, the high comes in at 101.8. What's the consequent encroachment level? 101.8. Now you're going to tell me, folks. You're going to tell me, okay, Mr. Order Flow, Mr. Level 2, Mr. Volume Profile, Mr. Elliott Wave, Mr. Gann, that all the buyers stopped having an interest in buying there. And then the sellers finally got interested at that price point and sent us down into the close of that day. That's what you're gonna go with. That's what you're going with, right? See, folks, I want you to understand something. Okay. When I show you something, when I'm talking about things, there's scientific data behind it. Just because you don't have it in your hands doesn't mean it doesn't exist. I'm not obligated to teach this to you. But when I see comments and people email me, okay, and they do these big essays that I don't have time to read, okay. So I appreciate you sending me these long-winded books of opinions, and you titled the email about there is no algorithm and the markets are this, that, and the other thing. Okay, yeah, look, there's people out there, all kinds of different religions. Okay, you're welcome. It's in our United States where you have freedom of religion. Okay, you can believe whatever you want. You want to believe in the spaghetti monster? Hey, it's your business. But in the markets, there is an algorithm. It is in every market, and it's controlling price. It's the delivery mechanism. Now, you can get all worked up in a frenzy about wanting to defend the opposing view of that, and it's not important to me. I could care less. But I want you to understand that there's nothing like this out there. And when I look at price action and I'm seeing certain things, when I'm looking at price, and this is on a daily chart, folks, this stuff exists on all time frames. And the only way that can happen is if it's scripted, coded, and someone knows what's up. Now, just leave that out there for you to figure out what that might mean, what it implies. Hey, I'm sure there's a Netflix movie in there somewhere. But the point is this: the market did, in fact, retrace right where I was saying it was going to likely do it. And the science behind why I said it was a good idea to do so. Remember, I'm doing it before it happens. I'm calling things on the daily chart before it happens because I got so many grievous messages or whatnot belly aching to me about how I can't watch your stuff anymore because you're only talking about intraday charts. Okay, I'm not trying to coddle all of you. I'm trying to show you that the lower time frames afford lots of opportunity for you to practice and study because the same thing that you're seeing on a 1 minute chart or a 5 minute chart is going to form on a daily chart. It just takes a whole lot more time for that to occur. Once it obviously delivers, you could be weeks or months before it's completed. How long are you going to stick with that exercise and trying to learn if you have to wait that long for the feedback? You're not going to stay with it long, folks. I know because I couldn't do it either. So I fell in love with lower time frames because it gave me lots of practice. It's like the shooting range. You go to the shooting range, as many bullets as you bring, that's how many shots you got. Well, if you can't bring all that many shots to the daily chart to do certain things and practice on, you're relegated to just simply looking at hindsight data. And at some point, you got to stop looking at simply hindsight data and market replay, and you got to stick to the hard right edge and figure it out. And how can you practice that on a daily chart any faster than one day at a time? You can't. Okay, so that's the reason why I'm on the lower time frames. I teach on the lower time frames because it's advantageous for you. Even if your model isn't going to be an intraday model, it's useful for you to learn that. Okay, so I've already used up all my time. We got 7 seconds left, and I'm going to have to go over time now. But I just wanted to toss that in there. Okay, you hear these people say there's always been imbalances in price. I didn't invent imbalances, folks. I codified the logic around how it pairs up with algorithm price delivery, and I codified that. Mr. Jones himself, here I am. Okay. So whether you choose to believe that or not, I could care less because there's nobody else out there telling you about this stuff before I did. And I'm answering people when I say this. It's not me saying it because I love myself. Many of you come here and you watch a video and you think you're an audience of one. You're the only person I'm talking to. Like nobody else has a question. No one else has anything ever sent to me. No one has a concern. No one has a doubt. When I'm talking, I'm addressing and responding to people. I'm not going to pull up their email and show you their novel they wrote me. Okay. It's pointless. Who cares? Okay. But I am going to address it because this person has a little bit of an audience. And I'm sure they probably are either being warmed up to that same approach or that viewpoint, or they're trying to attempt to do so with that crowd of people that's interested in what their opinion is. So, uh, again, just look at what we've done since the 7th of June. Beautiful run off of that inversion fair value gap. There is, for the support and resistance crowd, there's an old high back here, but it didn't trade there, did it? Didn't do that. But it used the logic with the bodies supporting the idea of that becoming an inversion fair value gap because it started as a volume imbalance and then it delivers buy side here and then sell side delivery and then leaves it. So watch what happens. The volume imbalance changes its characteristic to a fair value gap. Even though there's no bodies here, it was deferred at a different later time. Buy side was offered. That means the price simply was allowed to trade from its lowest point, which is this candlestick's close, to this candlestick's close. It traded from the low end of it to the high end of it and then back down. So we have up, down. And then when it leaves that range, this becomes a balanced price range. But we use it through the lens of a fair value gap that was down because we opened lower here, but the body stops on that close. So this separation between these two candlesticks, we measure that and we call it first a volume imbalance. But it was created by down delivery. Okay, so sell side delivery, not liquidity, it was dropped lower when it's formed. Over here, it goes up and down and then leaves it with this candlestick there. So it becomes a balanced price range. And we simply use the logic of it would have been, if this would have been like one candlestick bridging from here to here, this would be a sell sign imbalance, buy sign efficiency, or fair value gap. If we trade above it, like we do here, naturally, based on how I teach, that would be used as a inversion fair value gap, which is why I labeled this whole business on the 7th of 2026 of June of this month, gave you the analysis on here. It would go down here, go here, go here, and then draw towards this. But it does not need to on Wednesday when I was doing that recording, when price was still moving around and my son was sitting here saying, hit him something good today, Dad. Show him something really impressive. So maybe some of you missed it. Maybe some of you said, okay, well, that wasn't a big deal. Maybe this isn't a big deal.